Hi, everyone. Welcome to another episode of Upstream with RiverX. I'm your host, Kieran Berry, and today I'm joined by Anto Joseph from Stropro. How are you?
Good, Kieran.
Thanks for coming on.
Excellent. Good to be here.
Yeah, and before we jump into it today, guys, we have a standard disclaimer. So anything that we say or you hear on this podcast shouldn't be considered as financial advice. We obviously don't know the financial position of each of our listeners. So if you do need some advice, please reach out to a financial advisor before you act upon anything you've heard upon here today. But mate, thanks very much for coming on. And
Appreciate it.
I think for the benefit of our listeners, it'd be great if you could just perhaps give us an oversight of you, who you are, and I guess maybe your study and your background and how you got to where you are today.
Yeah, so my background's always been in financial services, 15 years. I started my career in private banking. So I was with Citi for close to 8 years. And I was fortunate enough to be part of a distribution team that built one of the largest investment desks there. So in an area known as structured products. And I'm not sure if you're familiar with structured products and have you come across them?
Yeah, we'll jump into what a structured product is.
Yeah, sure.
Well.
It's complex in nature. It's got its complexities, but they're very versatile and very dynamic instruments and typically used by a lot of private bankers to build very curated, personalized sort of offering around a client's objectives. So when I saw this in 2012, I joined the private bank. It was a $400 million fund business in structured products. By 2017, we were able to grow that with now my co-founder, Ben Streeter, to $5 billion. And there was a bit of a light bulb moment there for me to go, well, look, why are these unique investments or structured investments only available to the private banking ecosystem? Why couldn't that be made more available to the broader independent wealth advisory and high net worth market? And as you're probably aware yourself, 80% of the wealth market is not typically managed by a private banking individual. Mm-hmm. So it was very clear private banking is very small in Australia. And if you really wanted the full capabilities of what a private bank offers, could we get that in the hands of a wealth advisor so they could service their clients a lot better? In fact, elevate their offering to feel and look like a private banker. So it was in 2019, I sort of wrapped up my gig with Citi. I raised some seed capital to begin Stropro, which is the investment platform now. Mm-hmm. We've been going at this for now 5 years. Mm-hmm. We've traded almost $2 billion through the platform. We work with some of the best wealth advisors across the country. And I think, as I mentioned to you many times before, structured products are now mainstream conversation.
Mm. And just for the benefit of our listeners, I guess, can you explain, like you mentioned, they're a complex product used by private bankers and investment bankers. What is a structured product? Like, what's the foundation of it and how do you create a structured product?
Yeah, perfect question. So structured products, I mentioned they're complex, but they're complex because what's behind them is typically a derivative and some funding from an investment bank. So a structured product, by virtue of the term structured product or structuring, basically you can design a product around a client's objective, income, capital preservation, growth. They might have a view to protect against the downside in a market. So they might want some insurance in a situation where they're expecting or have a view that there might be a bear market. And they can point to any listed asset class. So commodity, currency, equity, bond, ETF. So the instrument itself it's a tool that's used to construct an investment strategy around a client's objective, risk tolerance, time frame. And that capability has typically been reserved to an investment bank. Mm-hmm. So these instruments or structured products are structured and created or issued by an investment bank. Across the global market, if you look at somewhere like the US, last year there was almost $200 billion worth of structured products issued in that market to high net worth investors who use these tools. They're designed to be a bit more precise in nature and the ability to target a particular outcome. But it does tell you that if someone like the US is issuing $200 billion of structured products and Australia's got a very tiny subset, well, we should be utilizing these tools a bit more.
And just unpacking that. So how does that work? So let's say I'm a financial advisor and I have a client that comes to me and says, Kieran, I'm looking for sustainable income over the next 10 years.
Yes.
My goal is to create a funding stream into retirement, for example.
Yep.
Is that something where I could come and sit down with Stropro and say, this is my goal. what does a product that delivers on that looks like?
Absolutely. So that's basically what we built. So if you think about a traditional private bank, investment bank, there's typically a dedicated investment team or product team that sit between the advisor and their client and the capabilities of the derivative or the investment or trading teams of these investment banks. And their job is to basically take into these requirements. So like you said, it might be income for 5-10 years. It could be linked to, Australian assets, US assets. It might be getting some downside protection. Ultimately, the role of Stropro, for example, is to sit there as the sophisticated intermediary in between to be able to take in those parameters and then build that product, with the help and the expertise of a panel of investment banks.
Mm-hmm.
So that's a common thing we do, particularly on the income side. We've been building income trades for clients and advisors for a very long time, but they can be very precise of what exposures they'd like and what level of protection they would like as well when generating that income.
And is this restricted to sophisticated investors, or can retail clients look at this sort of product as well?
It is at the moment predominantly to wholesale accredited or sophisticated investors. There is a market there for retail clients, but there is some complexity that is behind the scenes on these instruments, especially when you're dealing with derivatives, some funding from an investment bank. There is some complexity under the hood, right? A lot of that complexity, that's what we're there to deal with and manage and neatly package it up for an advisor or an end client. And the product is made available to retail clients, but typically under a PDS.
Mm-hmm.
But for wholesale clients, it's typically made under a investment memorandum or a term sheet.
Okay.
Yeah.
And so the way that would work is you would then build derivatives around a product, and or the investment bank would. So you basically get the mandate or the set of instructions from the financial advisor. They come to you. You then go out as the sophisticated intermediary, and then you then talk to the investment banks. And you've got a panel, you mentioned. How many sit on the panel?
Yeah, so we've probably got one of the largest panels in APAC at the moment. So we're the only sort of multi-issuer panel platform in Australia. We've got 10 banks on our panel, soon to be 12. So that gives us a full breadth of price tendering capability.
Mm-hmm.
So think about an advisor who may not have the capability to open up relationships with, 10 investment banks.
Mm-hmm.
Like a mortgage broker uses a panel,
Mm-hmm.
similar, Stropro is using a panel for its investment tendering.
Mm-hmm.
Think of it exactly that way. But to your question, that's one of the strengths of that capability is to be able to consult 10 plus investment banks on an investment strategy and design it for the advisor.
And then you'd have like a range of different strategies. So you got your income, growth, balance, and then more niche strategies that would be on a specific thematic. It could be like AI or Australian property, for example? Like, can you build
absolutely. That? I think that's where the versatility comes in, right? So I'll give you a couple of examples of both, right? So one on the income side, I think it's been a common conversation in a lot of the podcasts as well about the whole hybrid phase out, and a lot of people are going, look, how do I replicate that level of income and replicate that kind of risk level, right? If not better the risk level, and generate that same sort of profile or investment profile. So on one side, you could create a structured product, and this is a very popular type of strategy, where you could link it to the big 4 Australian banks or big 5. You could create some downside protection up to sort of 50% on those banks, meaning that as long as those banks don't fall by 40 or 50% of their value, your capital's secured. And in return, you could get an income for that anywhere above 8 to close to 9%. So that's a typical example of an income-focused structured product. On the other end of the spectrum, if you have a client who goes, look, I've got a really tactical view on the market, right? I really think the NASDAQ over the next 5 years is going to accelerate in value, right? You can create a leveraged play on that thesis. And there are a couple of ways, advisors might play that. They might go buy a leveraged ETF, to get some leveraged exposure. They might take a margin facility and then borrow money to effectively, replicate a leveraged position. But both those sort of options are quite costly. But with an investment bank, I can use their balance sheet to create a leveraged position over 5 years, which might become a lot more cost efficient. In fact, a recent example we did, a client might pay about 20% upfront, as a cost. So for every $20,000, it would look like they're invested $100,000 into the NASDAQ futures. So that's 5-to-1 leverage. That's your only cost. So as long as you believe, the NASDAQ over the next effectively 5 years is going to go up more than 2% per annum, you're going to you're going to be in profit territory.
Yeah.
So I'm able to leverage the balance sheet and the expertise of the banks to create, very unique and targeted sort of trades around an advisor's view or a client's view. But at the same time, there are more vanilla income generating ideas, which are a lot more easy for clients to kind of understand and sort of replicate in their portfolio.
Yeah, we've seen some of those strategies with clients that have come to us where they've been in the more conservative, sort of the slow and steady income style strategies. And I think that's how we've originally connected.
Yes, that's right.
But those clients seem to really appreciate those sort of monthly income style strategies, which have come off the back of hybrid phase out, the emergence of private credit in the Australian market.
Absolutely.
How does on the income product side, I know there can be lots of variables with the derivatives there, but how does the income compare to, say, like the private credit funds in the market? Think like first mortgage. At the moment with rates it's probably more like 7 to 9% max on first mortgage. How would that compare on like an index income style solution you've got?
Yeah, absolutely. And I think one common, mistake we always try to avoid is, we're definitely not trying to say private credit in any way. Structured products are a replacement to private credit. In fact, as rates are falling, as people are getting a lot more exposure to private credit, structured products and generating income is just more of a diversification tool. So that asset allocation gets a bit more spread. In terms of comparing, the interest rate or the yield, I would say it's extremely comparable. The average yield across the book has been well above 10% on the income style strategies. And we're pointing to Aussie blue chips, US, European, US consumer staples. These are not names that people are unfamiliar with. They're typically top 50, top 20 names across the globe. So replicating that same level of income, if not in the double digits, but also having, like an LVR in some respects, replicating anywhere between 40 to 50% downside sort of protection or insurance is quite common. So
okay, so yeah, it's good to mention because we've got a lot of people that come to us for income, and a lot of the people that we deal with would be either sort of sophisticated investors that might be self-funded retirees. We also get a lot of founders that have exited as well, and they're looking for that sustainable income going forward because they might be even if they're a younger founder that's exited to PE, for example. They're looking for that steady income for their family. And they might have a pool of cash, but they don't necessarily want to erode that. So they look at these positions as a way of supplementing their income that they once had from their companies.
Yes.
How about the costs of these things? So if I wanted to compare it to other comparable sort of income solutions, how does that stack up from a I guess cost?
From a cost perspective?
Yeah.
Absolutely. So any one of those rates I've mentioned are typically net of any sort of fees. There is typically an arranger fee or a distribution fee that's priced into the product. So let's say hypothetically we go to Citibank and price an income trade linked to the big four Australian banks, right? In that there might be a 1% distribution fee or arranging fee that's noted in the term sheet. So that product might initially have been a 10% paying product, but with that 1% fee, the client's getting 9%.
Got it.
So it's quite as simple as that, really. They're baking in a little bit of margin for those who are arranging the product, the distributor effectively, to be able to distribute that to the market.
Okay. And how does one, I know you mentioned it's, the advisors come to you. Can clients work directly with you, or is this something where you must go through a financial advisor?
Look, we do have a portal which allows clients to come directly to us, but it's just not our preferred option. I think what we find is where the advisor is involved, they can think a little bit more holistically about the client's situation. At Stropro, we're like dedicated to the structured product segment. So if a client wanted to ask me a little bit more broadly about how they do asset allocation, strategically in their portfolio, tactically in their portfolio, we're not equipped to have that conversation. So where we found the most value add is where an advisor is looking after things more holistically across the portfolio, from their private markets exposure to their broader, more vanilla, maybe fixed income, equity exposure. we kind of play this role as the quarterback in there to be able to go, okay, look, you've got a gap there in the portfolio. We can see there's an income gap, right? You're worried about, like you mentioned earlier in that example, like, we're going into retirement. We want to sustain a level of income to meet our, sort of needs. We're there to identify gaps for the advisor that otherwise they can't solve, doing things the traditional way. And that ability to have more certainty in the portfolio or certainty of outcomes, a lot of investors appreciate that. Particularly if a client goes, look, I'm looking for a minimum 8% income. I want not to take on too much market risk, or you remove the volatility for me. The ability to deliver a product that says you're getting paid 8%. This is your market risk. It's defined. These are assets that you're comfortable with. That ability to be really precise and certain with the client tends to be a very good conversation to have. And so I think our preference is always to work directly with advisors to be able to be, more fruitful in the conversation to build a strategy.
Well, we found that with you as well. We've had sort of clients, when other advisors have joined us, they've had clients that come with them, and then, some clients who may not come with them, and they come to you guys direct, and then it's a case of saying, well, no, you need to go through your advisor because you don't have the financial literacy to be dealing in the products, right?
That's right.
So you can provide them with a layer of protection. One of the things we're trying to solve for through hosting a podcast like this is creating more awareness in the community about investment products, solutions, and advice.
Of course.
I think I was looking at a statistic the other day, something like 80% of the Australian population is unadvised. And then the remainder of investors that are in the market, they tend to be self-directed. What are some of the challenges you face? Like you've mentioned a couple there, but do you face challenges when people come to you on a direct basis to try and implement the products?
Yeah, look, at that point in time, we typically guide them towards an advisor, right? Because the questions they might come up with are broader than just an investment strategy. It's about the structuring across the family unit. It's a structuring from a tax perspective. It's estate planning through years. It's a bit more of a broader picture. I think it's sort of almost custodians in the financial services space. What's interesting for us is we typically direct those clients into an advisor to seek that advice. Now, one of the unique nuances of the market has been the fact that, once accountants were kind of the very critical, integral figure in a conversation, that still happens a lot today. Like we find that a lot of self-directed clients use the accountant as a source of advice, so to speak. And look, accountants, very well capable of, handling things from a cash flow, forecasting perspective, understanding the full dynamic. But advice is a different game. So look, in a lot of those circumstances, I find that self-directed clients, particularly on the high net worth sort of bracket, particularly investable assets, 3 million plus, you start to get into a different world where advice is really integral. And it doesn't need to be, holistic advice on every aspect of your life. It could be very targeted advice. That's also what we find that's quite nimble with advisors these days. They can target their advice to certain parts of where they are, whether in accumulation or in retirement stage. They can really be a bit more targeted on what role they play alongside an accountant or alongside their own, the client's own sophistication. So my view is advice is super important. I've been in financial services for well over, like I said, 15 years, but I have an advisor, who looks after my financial affairs. And that's for me as a sounding board. There are things that I'm not, completely aware of that I should be thinking about. So, advice is important.
Yeah, we had the same conversation. So we have sessions where we bring in external professionals, and we brought in one of the top business writers from Macquarie and a top writer from Morgan Stanley, just to have a conversation about how they're going about business. And it's not for us to try and win them as advisors to work for us. It's really just about having a conversation with our team about what's driving value in the advice community. I reckon you're spot on. When we sit down with clients, the investments are 10% of the conversation.
Absolutely.
While critical, what the broader issue is, do you have the right structures in place? What's the after-tax outcome? Because that's what drives a bigger marginal return for the investor. Like, what's the problem we're solving for here? And then coupling that with solutions like yours helps us get to that end goal.
Exactly.
Where it's like, okay, this is the piece in the puzzle that helps them get to that destination or solve for that problem. So it's really critical that we have the right solutions, the right protection, the right security that all sort of marry up to that end goal. Speaking of security, we were chatting just before we started about the different platforms that you're live on and custody arrangements and all of that. So if an advisor is listening to this and they want to use your services or learn about your product, do they come straight to Stropro or can they go to a relevant platform? How's that work?
So the relationship with the platform is just born out of the fact that we understand that advisors are using multi-platform and they don't want to add another platform into the mix to be able to access products, so to speak. So our relationship with the platforms is quite simple. Our integrations with them, it's either custodial or non-custodial, meaning that effectively anything that you do with Stropro and our investment team, where we go out and build a strategy and structure a product for you around your objectives, once we do that arranging and about to execute, we basically point the custody to your preferred platform. In the case where it's a non-custodial relationship, we'll point the reporting to your preferred platform. So we like to think that advisors can stay, completely contained, in the environment that they're currently working in to get their, basically total picture of a client's portfolio, and we don't want to disrupt that. So like you said, it's really to enable them to service their clients more holistically, and that relationship is custodial, where we can point the asset to their preferred platform or the reporting to that preferred platform.
And then I guess the next thing is duration on the products, right? So we've talked about security, investment underlying characteristics, duration of the products. So how does that work? Is that something that's dictated by the advisor, or would you, like, say if I came to you and said, I need something for the next 5 years or the next 10 years, is that that's linked to a particular index or a particular asset class? Is that something that the investment bank would dictate to provide the outcome for the client?
So no, not necessarily. Like 95% of what we do is we're taking into account, whatever the preference of the advisor is, whatever exposures they would like, and their target returns and target sort of, risk parameters, and then basically plugging that through to an investment bank to price. Now, our investment team with our expertise, there's very solid bench strength there, well over, 10 plus years now doing structuring. So we would have some recommendation to that advisor. Oh, look, maybe tweak that approach. Maybe this is a better asset to consider. You've chosen these ETFs. Maybe these ETFs will get a better outcome for you, and they're better priced, they're a bit cheaper, you can get more leverage, whatever it might be. So our job in that middle section is really, and acting as an intermediary, is to be able to tweak what the advisor has, sort of come up with to get a final outcome before we start sending it to the banks for pricing. Mind you, the banks might turn around and say, hey, look, we can price all this, but by the way, we're doing this for an institutional client or another client in another part of the world that probably you should take consideration of. So we do get fed ideas top down from the investment bank as alternatives or other strategies that are popular across the globe. That's really helpful just to understand what's happening. But most of the time, the work is done by our investment team to get closer to exactly what the advisor wants.
So you get to the core of where they want to end up, and then you're solving for that through sort of constructing a product.
Exactly. And that's the exciting part of what we do. Like, the velocity is insane. So just to give you an idea, like, over these last few months, we're doing anywhere between 40 to 50 products a month, right? What does that tell you? That tells you that there are 40 to 50 trades across the network from wealth advisors who are going, look, I really like, gold at the moment, or I want to hedge gold at the moment. I want capital protected exposure to this ETF. I want to generate income, but get some downside protection on Australian blue chip basket. One of the other popular things that we've seen recently is clients are holding single stock concentration, we find. So they might have bought CBA on the float. They picked up a couple of $1 million worth of CBA at the moment. They don't want to sell the CBA stock because they'll trigger a capital gains event. We can use the expertise of those banks and their capability to release equity on that single stock up to 80, 90%, and be able to release that equity to the client without triggering a sale. And now that client can diversify that 80% of that holding to effectively go diversify in the market or invest elsewhere.
So that equity release, that just gives them that flexibility while they're within the structured product to
Yes.
see it through to its duration.
And why there's a structured product there involved, so to speak, is because there is a derivative there. The derivative is you're taking a loan on the stock, but you're also consequently at the same time protecting using a put option, typically, to the value of the loan. So let's say you take out 80%, you got $1 million stock, you take out 80% of its value, so $800,000 worth of its value. You also want to be protected if, that stock falls in value, right? You don't want to be margin called on that. So unlike a margin loan, there is a put option written at 80%. To protect the value of the loan. So if the stock goes from $1 million now to 700,000, you're not going to have to fork out the margin for that. That's the unique part of the structuring component there.
And would you say that options is the main way that you structure the products as with the deriv? Is that the main sort of vehicle that you use?
Typically it is. Yeah. And most advisors out there in market and those who have been using options for a very long time and those who are new to options, one thing that we've found as the kind of, middle line between all that is that if you're using an options book, you're managing exercises of options, managing a full option book, maturities, all sorts of stuff. There's a lot of active involvement required there. That's also what's preventing new advisors using options because they go, that's a bit too difficult, right?
Yep.
So we play in that little middle part in between. We go, we'll neatly package all the options together, in one singular product or structured note.
Yep.
And you get the benefit of that without having to manage all the complexity that goes along with it.
We had so I was working at Sharon Partners for 10 years, and their derivatives book shrunk significantly over that time. And when I first went there was a lot of guys trading options, and that was 2012, I think. And I would say that by the time we got to 2017, it had halved. And then you go to today, it's probably 10% of what it was. And that's just because we've got increased costs, increased margin requirements. There's increased levies in terms of, what the clearinghouses want from you to participate in those strategies. So they typically want a bond. For you to be able to trade derivatives, it could be $1 million bond you got to pay to these guys. So we've taken a position at River where we've said, we'll look at things that make sense, but in the main, we probably don't want to be there in terms of derivatives. However, we are happy to have exposure to the strategies to a structured product or an ETF or whatever it might be. We just don't want to be the ones actually crafting the strategy. For those reasons I mentioned, but the other is, is it right for a financial advisor to be structuring their own products? Probably not, in my view. I would say that in most cases, their job should be servicing the client, getting the structures right, and being an advice-driven business rather than an execution-driven business.
Yes.
So do you see that happening now, like people who are formerly in derivatives looking to a structured product provider just to take the noise out of it for them?
Absolutely. Some of the top advisors in the country use structured products as a main vehicle to be very targeted on an objective. So to your earlier point, what's very interesting about what you said was, there is a lot of difficulty in managing an options book and or a derivatives position. And there's more considerations for the licensee and the dealer group and the business to manage through. So structured products is definitely a unique way to get rid of all that noise and to be able to have the benefit of the balance sheet funding of an investment bank and the derivative component all wrapped up into one. So it's beautiful from that perspective. But I do agree with you that a lot of the structuring shouldn't be put in the hands of an advisor. That's why there is a dedicated investment team who has the expertise to be able to handle that, right? And look, some advisors are super savvy in the sense that, I understand how the layering works. I can try and, have that conversation with a derivatives trader on the other end with Citi or UBS. That's perfectly fine. But, having this sort of check and balance in between to be able to go, your objectives are here. These are the ways that you can obviously tackle that objective. Here's the team that has the expertise. We'll go consult the banks. We'll also take out some of the noise from the banks to be very, precise on the appropriate strategy to cover that objective. So I think that kind of, while I don't like the idea of adding so many middleman layers, this is an important one. That layer in between where there is a dedicated investment desk, particularly for the complexity of these products. I think that's it's efficient and it's very, important that the client's seen that there's multiple eyes been over it.
Yeah, I think that's good from a comfort standpoint for the clients as well.
Yeah.
In terms of, I guess, going to market and connecting, your market is dealing with financial advisors, I take it.
Yes.
So if someone wants to find you, how can they find you?
It's pretty easy. Like you can go through our website. We have a dedicated advisor portal. So once you go through us and, learn a bit more about us there's two things you can do. You can book a consultation with the team. So we can go through the capabilities. We can understand whether we're the right fit for you. Like, would structured products make meaningful sense in your asset allocation? So you can book a consultation through the website. Very easy to do. You can join the portal and have a look at exactly what's happening across the network. That's something we like to show. We like to show a lot of case studies and of trade ideas that's happening everywhere. And most of the time you find that, oh, look, that strategy that this advisor did from this firm, that's very relevant to what I'm doing. So it's easy to kind of piggyback on other good trade ideas as well. So you might not always have your own idea. You might not be very, clear on exactly what you need to solve for.
Yeah.
So use the ideas that are already there. So that's one way to get in touch. And obviously, the team's here, myself, and I've got a team of, 3 analysts, a couple of people in our sales team. We're sort of ready to take on, direct sort of meetings as well.
Yeah, great. So you head to stropro.com.au, I take it?
That's the one.
Jump online, book in a time for
Stropro.com, I should say.
.com.au, okay.
I think both work, to be honest.
If you've got both domains booked, it should.
Yeah, it should work.
But that's great, mate. Thank you so much.
Excellent.
For your time today.
No, thank you for your time and the questions.
And hopefully this has been insightful, and thank you everyone for joining us for another episode.